Welcome. This is Mike Hood, president of Hood Financial, and thank you for watching. During the next 15 minutes, we're going to discover together the answer to this question. What will be the most expensive years of your retirement? Here's a little hint. It probably won't be the first few years. We're also going to talk about the many financial risks you face during this exciting, open-ended journey we call retirement, and how, with proper planning, I can help you to avoid many of these risks. After watching this presentation, you'll see why I should be your first choice for a second opinion about your retirement planning. We'll begin in just a minute, but first, the all-important disclaimer, for the lawyers. Now that we've got that out of the way, for over 30 years, I've helped many people just like you protect all your hard-earned assets and enjoy a worry-free retirement. One of the ways I do this is by helping you to identify, mitigate, and eliminate the 7 retirement risks. My services focus on 3 major areas: financial planning, investment management, and asset protection. Today, we'll be talking mostly about asset protection. Now, some people think living trusts when they hear asset protection, and yes, they can be part of the equation, but I go well beyond living trust planning and look for all the ways your assets and income may be vulnerable to loss, and then help you to protect them. In fact, when it comes to protecting yourself against the biggest financial risk you face during retirement, most living trusts are completely silent on the matter. So, what will be the most expensive years of your retirement, and how will you pay for them? That is a pretty loaded question. You might imagine that the first few years of your retirement would be the most expensive, as you take up new hobbies, do some traveling, and pursue other interests. Those expenses are predictable, and hopefully you've planned for them all. But what about those unplanned expenses? This is where a lot of people get themselves into trouble. In order to successfully navigate your way through retirement, it's critical to understand the 7 basic risks you will face. There are actually a lot more than 7, but these are the ones I tend to see most often. Knowing how to eliminate or minimize these risks is just one of the keys to your enjoying a worry-free retirement. So here they are. Longevity, the risk of outliving your money. It's no secret that people are living longer than ever before. In fact, let me share with you a personal example. This is my grandmother on my mom's side, Ruth Williams. She was born in 1904 and died in 2011, just a few weeks shy of her 107th birthday. She lived most of her life in Redondo Beach and actually had an article written about her in the local paper after her passing. Surprisingly, she really had no secret to her longevity, other than that she tried to stay active and always kept a positive outlook on life. As a result, she was healthy enough to never need much in the way of care, but she did live for a while in an assisted living facility just for a change of pace. She was well over 100 years old at the time, and after about a year, she felt that place really wasn't for her. As she put it, there were too many old people living there, so she moved back home to live with my aunt. So here's the $64,000 question. How long will you live, and how will that impact your retirement? There's a website called livingto100.com that just might give you a clue. When I took their longevity test, it revealed that I would also live to 106, just like my grandmother. At my age, 59 today, looks like I'm going to be around for quite a while. Back to our risks. For now, I'm not going to spend a lot of time on each of these, but if you only remember one thing from this presentation, it ought to be this. Unless you have a written retirement plan in place, and that plan specifically addresses these risks you see here, there's a good chance your retirement will be suboptimal, not as good as it could be. I would like to highlight just one of these risks, sequence of returns, or what I like to call the silent killer of retirement plans. Here's how this could affect you. During retirement in the decumulation phase, fluctuating markets and returns have a greater effect positively or negatively on your portfolio than during pre-retirement or the accumulation phase. This could cause you to run out of money a lot sooner than you expected. Time does not permit an in-depth discussion of this risk, but just know this, the devastating effects of sequence of returns risk is often too subtle to be recognized until it's too late. And last on the list, we have long-term care, the risk of depleting your assets due to a need for extended care. And this, frankly, is the biggest financial risk and expense you will face during retirement, and is often completely overlooked in most of the retirement plans I review. Not so with our clients. According to a report by AARP, if you're over the age of 65, you have a 70% chance of needing some type of care in your lifetime. Care is defined as any cognitive decline or compromise in health condition requiring assistance from others for your basic activities of daily living. How long such an illness might last and how much it might cost are all questions no one can really answer for sure. But according to a report by Genworth, in 2019, the average cost of a private room in a nursing home was a little over $100,000 a year. Depending on where you live and your level of care, of course, your costs could be much lower. However, those are just the costs as they are today. If we apply a little inflation and some time to the mix, well, you can see what happens. Now that we've talked about what long-term care is and how much it might cost, let's focus on the non-financial impact a long-term care illness can have on families. If you're like most people, you've not made a plan for long-term care, and quite possibly because of the solutions you've been offered up until now. We'll talk more about that in just a minute. Without a plan, the burden of care typically falls on the family, and there's usually one child that takes the lead for that responsibility. This tends to create some tension between other siblings who may not be as involved because of work, location, or other reasons. Careers and families are disrupted, and sadly, without planning, a long-term care illness can often tear families apart. Traditionally, there have only been 3 ways to pay for long-term care. Most people don't want the government dictating their healthcare decisions, but if you did want them to, you are required to spend down all of your assets first before Medicaid will kick in. This is not the plan most people would choose. You could buy long-term care insurance. However, this might represent a lot of wasted money if you are part of the 30% who will never need care. Besides, who wants to end up in a nursing home just so their long-term care policy doesn't go to waste? Given these options, it's no wonder then that most people simply take their chances and choose, by default, to self-insure, using their own money to pay for care if and when it's needed. So is that really the best alternative? One of the problems with self-insuring for the cost of long-term care is that your money has a finite life expectancy or value. It can only last so long. Also, think about it for just a minute. If you needed care, which assets would you liquidate first to pay for it? Your best ones or your worst ones? And how would liquidating those assets impact your surviving spouse long after you're gone? Even if you were independently wealthy, you wouldn't want to self-insure for things like your car, home, or potential liabilities, would you? Of course not. So we've ruled out relying on the government, buying long-term care insurance, and I'm sure you can now see the problems with self-insuring. But what if there was a fourth option to consider? One that gave you all the advantages and leverage of insurance, but with the flexibility, liquidity, and control of self-insuring? And what if you could pay for some of those most expensive years of tomorrow now at a discount without giving up your current or future lifestyle? I'm talking about a way for you to maintain dignity, choice, and control while still preserving your capital. You could call it self-insurance on steroids. Sound impossible? Let me introduce you to an asset-based solution. This strategy differs greatly from traditional long-term care insurance in many ways. With an asset-based solution, whether you live, die, or quit, you haven't wasted any money, as you might with a typical use it or lose it approach. There can be many advantages to this strategy. First, money is available regardless of what happens in the future, taking all the guesswork out of your planning. Next, everything about the plan is guaranteed. The premiums, cash growth, a death benefit, surrender values. There are joint policy options allowing both spouses to receive care even at the same time. And finally, lifetime coverage is available for both spouses with inflation riders to cover the increasing costs of care forever. Let's take a look at just one way this plan might work for you. Most investment portfolios are made up of varying asset classes and risks, conservative, moderate, and aggressive. And chances are, if you're planning to self-insure, you may have already earmarked some conservative, lower return assets to use first towards the cost of care. By reallocating some of those conservative assets today into an asset-based solution, you avoid exposing yourself to the enormous asset drain of a future long-term care illness. These funds would go into an insurance contract that maintains liquidity, but adds a death benefit higher than the original deposit that could be used if long-term care was needed. In this simple example shown here, $125,000 is set aside today and immediately becomes $200,000 if death occurs, or $200,000 in the event of a long-term care illness. There are also lifetime benefit options to choose from, which creates an unlimited pool of money to draw from with inflation for life. I should point out that there are as many variations on this strategy as there are people, and it can be customized to fit your particular financial situation and goals. Simply put, an asset-based solution such as this allows you to maximize your asset values, minimize your costs, and eliminates any wasted money along the way. One of the other unique features of this asset-based solution is in the many ways it can be funded. First, you can use plain old savings, CDs, cash, etc. Funding can also come from current income or a combination of income and lump sum deposits. Some people will choose to liquidate underperforming investments and use them for the plan. There are also many creative ways of using retirement accounts, IRAs, 401ks, etc. Even existing life insurance and annuities can be converted into this plan and are becoming a more popular funding source as well. Speaking of annuities, do you know if your annuity is compliant with the Pension Protection Act of 2010? The what, you say? Well, this little known benefit in the tax code can turn tax deferred to tax free for LTC. Here's a little background. Most non-qualified annuities, those that aren't part of a retirement plan, are made up of principal, your original deposit, which is never taxable, and your gain or interest, the earnings you've accumulated, which is forever taxable. When you take a withdrawal from these annuities, it's the taxable interest that comes out first. Many people continue to own annuities such as these with the thought of using them towards the cost of a long-term care illness so as to not be a burden on their children. Now, because of the Pension Protection Act, newer annuities that qualify for this special tax treatment are allowed tax-free withdrawals when the money is used towards long-term care expenses. Basically, you can take what would have been taxable income and turn it into tax-free income for life. However, there's a pretty good chance that your existing annuity isn't compliant with the Pension Protection Act. There's one way to know for sure, and that's for you and I to talk soon so I can review your annuity to see if it's eligible for an upgrade. Most of the time, these types of upgrades can be done all without taxes, fees, or costs of any kind. As a review, longevity risk and long-term care risk will have the greatest impact on your retirement. And that's because longevity is not just a risk, it's a risk multiplier of all the other risks. The longer you live, the more likely you are to experience a market crash, run out of money, see increased taxes, interest rates, and inflation, or you might have a need for long-term care. Those final years, ladies and gentlemen, could very well be the most expensive years of your retirement. And as we've seen, with current care costs today running around $6,000 to $8,000 per month, and with those costs expected to double about every 15 years, well, you can do the math. Self-insuring for long-term care could end up being the biggest financial gamble of your life. Please don't roll the dice with your retirement. In conclusion, as you look to the future, you'll either live, die, or need long-term care. Sorry to paint such a bleak picture, but using an asset-based solution as part of your overall retirement planning will provide value to you or your heirs, regardless of what happens or in what order. We've also established today that most likely the last several years of your retirement will be the most expensive. Ignoring the problem won't make it go away. I think it's also important to point out again that living trusts offer no protections whatsoever against the estate draining costs of a long-term care illness. However, the additional planning you and I do today could greatly mitigate the financial effects an extended illness would have on you and your family. If you like what you've seen and heard today, take the first step towards maintaining dignity and control of your future health choices by scheduling a Get Acquainted phone call with me so I can learn more about your particular situation and determine whether this asset-based solution for long-term care is right for you. Again, there are many creative funding options we can choose from, and most of our clients find that they do not feel any negative financial impact by having this strategy in place. Please click on my calendar link in the video description below to schedule your complimentary 15-minute Get Acquainted phone call. There is no cost or obligation of any kind, and I really do look forward to speaking with you soon. I've appreciated having you with me today, and thanks again for watching. This is Mike Hood of Hood Financial, hoping you live a long and happy life and healthy enough to celebrate your 106th birthday in style.